Hi, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. It is March 23rd, Saturday, March 23rd, and we're looking at a chart of the S&P 500 index, cash index. And, we had an interesting week. There's just been a lot of positive sentiment in the market, and I'm going to show you that in a minute. But one of the things I want to point out here is how we came right back to the bottom of this this channel. So we broke the channel, came back and retested the bottom side of the channel with a pretty deep correction. I mean, if you look at if you measure this down, we had more than a 78% or right at 78% correction back up. In fact, let's just measure it real quick. Take our Fibonacci tool and go from high to low. So go from here to here, and you can see we went more than 78.6%. Now, I will say this, usually once you go more than 78.6%, you end up getting a whole retracement, or, this is not counter trend. But the sentiment and the way some of the market measures are, it just seems like it's got to be counter trend. I don't know. Nothing's ever for sure in the market. I mean, there's a possibility that analysis is wrong, but I'm going to show you some indicators from the last several Elliott Wave short-term reports, and you're going to see that this action, the market internals in this action are pretty amazingly bullish, meaning the vast majority of people think the market's going to go higher. Well, the vast majority of people are always wrong, always wrong. So you can and the reason they're always wrong is because crowds, the market is it's a crowd type phenomenon. It's when the crowd gets too far on one side, the market flips and goes the other way. So you can kind of watch what the crowd is doing if you have the right tools, and you can take the opposite side. And I'll elaborate on that in a minute, but I just wanted to make sure that I'm not just saying what I'm saying because I believe the market's going to do this, or I believe the market's going to do that. I'll be honest with you, I do have a bias, and it's cost me, because this whole topping pattern has taken, look how long it's taken. It started back at the end of 2017, basically. Ran up to a new high, made a low, ran up to a lower high. We're talking about almost a 2-year topping pattern. Well, you can, if you're bearish right here, you can, and it starts going up, you can lose a lot of money over this time. So it's kind of a bad thing to have a bias, but to me the risks are so great that I didn't want to be on the bullish side of this. I think even back here we were talking about, okay, let's say it goes up another 1%. Is it really worth it if it crashed, to try to get that extra 1%? And look what happened. It went down, and what did we get here? Maybe an extra 1% at all this time. Okay. And that's what I meant. If some of you remember those episodes where I was talking about, is it really worth it to try to get an extra little gain here when there's so much risk on the table? And I still feel that way. And the market has a way of lulling you to sleep when the risks are the greatest, and they call it complacency. But you can see this channel here. This channel goes back quite a ways, and you can see back here we broke it to the upside, came down, went to the downside, didn't quite make it to the upside again, then broke it for good here, and then retested it. And this is a pretty common technical analysis, and so I think the pattern here shows that it's bearish. It's just the timing of, when is it going to break, and break hard, in which you don't want to be in it. That's hard. That's a lot harder to predict, and a lot harder to, in fact, it's impossible to predict. You just have to watch the market, pick your places, and decide when to get out. Okay, so I think that's all I want to say about the S&P 500 for now. I'm going to go back to it here in a minute. Let's look at the 13-week Treasury, which is like the 3-month Treasury. There's still just a ton of talk about the Fed and what's the Fed going to do and all this. You know, my position here on this program has always been that the Fed, it doesn't matter what the Fed's going to do. The Fed, I think what'll probably happen in this next downturn is the Fed's going to be discredited, because the Fed's going to try to lower rates when the market starts to sell off and crash. But what's going to happen is higher rates are going to be going up. I mean, the longer rates are going to be going up. So they're going to be trying to lower short-term rates, thinking that they're going to have an effect on long-term rates. And I think long-term rates are just going to go sky high. And people are going to go, well, what's the purpose of the Fed if it's not to, help manipulate these interest rates? And so I think the Fed does manipulate interest rates, but it does so not by setting the Fed funds rate, but by buying assets. So, if the Fed is bound and determined to print a bunch of money and buy a bunch of longer term assets, well, yeah, then they can drive, they theoretically could drive the long term, the long end of the yield curve down. But I think there's going to be a lot of hesitancy to do that, given that the balance sheet's already, near $5 trillion. So most of you are probably not following what I'm talking about, but you'll probably learn more about the Fed as this whole topping pattern unfolds and starts to turn south. But the thing you're going to learn that's the most important is that the Fed will not be able to save us from this catastrophe. All right, 10-year yield. 10-year yield has gone through our support area, which means it's likely to go lower. And it may not go lower right away, but our next level of support, well, there's a little bit of support around this dotted line here, but really our next level of support is down here. And so probably what will happen is the market starts selling off, the 10-year, money will start running into this 10-year Treasury for safety reasons and drive the yields lower. And so that's what I'm looking for to happen. But you can see there's a little support right in this area around 2.35. But then the next major support, and what I mean by major support, let's go to a monthly chart. And you've heard me talk about swings and stuff in here before. But if you look carefully here, you can see there's a swing here from the low, and then there's a swing down to here, and there's not another noticeable swing low. I mean, I guess you could say here, but then this wasn't a high, so maybe here, and there was a little pullback to here, but we've already broken through that. So let's say a swing to there. Let's just and maybe a swing into here, and then a swing into here. But again, I don't think this swing really counts, but even if it does, we've already broken through it. I mean, it doesn't count now for sure, because I put it on here because it was a little bit of support area. But now that we've broken through it, our next swing low is right here. Okay, that's why that yellow is on the screen. In fact, it looks like maybe that yellow might be a little too far down. I can't, it's way down here at the bottom. Let's see if I can move it up just a tad. Yeah, let's move it up to there. And these are arbitrary, but we might get a little bit of bounce next week and then resume to the downside. It might take 2 or 3 weeks to get down here, but definitely looks like yields are going to go lower. So if you're still in those bond funds and you're looking to get out, this is so anywhere between here and right here is a good time to be working your way out of those bond funds. I've been calling for that for a long time, but it's the same kind of theory. There's so much risk in bonds that it's just not worth the extra little money you're going to get out of return in these little run-ups, or these little sell-offs. Like the sell-off here, you made some money. This sell-off from here to here, you made some money. Of course, if it sells off from here down to here, you're going to make some more money. But the risk is really to the upside. Okay? All right. Volatility, very historically low. I mean, volatility, that's just low for volatility. 16.48. So, I wouldn't be surprised if we get, a volatility spike next week, and then we get, several weeks, and sometimes these can get quite large, when the selling really takes off. And again, what this is, for those that don't remember, volatility is just a measure that they use in the market. Well, let's not talk about what it is. Let's talk about what it reflects. What it reflects is the demand for S&P 500 index options, put options. So as volatility goes up, what happens is more and more market participants are buying insurance, insurance for the downside. And what happens is the more and more people that want insurance, the more and more expensive it has to get. And so that reflects, that's what volatility is, okay? We can talk a little bit more about it here in just a second. I'll go back to the S&P 500 and I'll explain what I'm talking about. But let's look at these foreign countries first. You've had a little bit of bounce in Germany, but we're at the upper end of this channel. You got Japan. Same thing, a bounce, but we're in the midpoint of the channel. And then the UK. UK looks the strongest to me, but we got a doji here, so who knows, it might roll over here. It might just trade sideways for a while and then take off again. But we'll be able to say more next week about the UK. If you're in the UK, if you're in the FTSE 100, you might just stay in it. And then when you get a close below this low, like if you're trying to decide, okay, when do I get out of the FTSE? Well, if you get a close below here, then you might want to step to the sidelines. Okay. All right. Let's go over to the regular TOS charts, and then I'm going to circle back around to some of these things that I want to talk about. Okay, this is the Euro US dollar. You can see we had a run up. Let me get off this. Let me get on a weekly. So you can see last week we kind of ran up, and that continued the early part of the week, and then it turned around and sold off. So it looks like to me at this point the euro wants to take out this low, and so I would expect that to happen over the next few weeks. Have the market work its way down, maybe over the next 2 months, have it work its way down to these new lows, probably around par. And then there's going to be, a pretty good run in the euro after that. So, but I wouldn't be long the euro right here. Now, if it holds this little downtrend line here, if it holds this and doesn't break through it, and starts to show signs of bouncing, you could go long the euro, up into this old high here. In other words, this is probably some sort of A, B, C. But I'm not sure this is complete. It's showing a lot of rejection around this moving average, which is in this case, it's the 30-week moving average. We broke through the 30-week moving average, tested it, failed, tested it, failed, tested it, failed, tested it, failed. So, you might want to use this 30-week moving average as a guide. I mean, if it comes down and makes a low here and then starts to rally, and you get 2 consecutive closes, like this, that are bullish, you're more than likely going to break the 30-week, and then you can go long the euro, I think. But right now, I'd either be sitting on my hands, or I'd be taking some sort of short position down below this line somewhere. All right. Okay, let me get back over here. Let's look at, I got to put these in manually now because I've lost my little connector thing that connects my list of charts over here to the charts themselves. But so here we got gold. Gold is in some sort of triangle here, and I think it's done here. So I think this is the move down. So we're going to have some sort of A, B, C, maybe down into this area. And then you're probably going to see gold break out of this triangle and go quite a bit higher, maybe up into this this box up here. Again, if this is A, and then we've got A, B, C, D, E into here, and then a breakout. So essentially what you have is you have A, B, C. So if you want to look at, how do you trade that? Well, first of all, you have to wait till E is over, and E is going to be over somewhere around in here. So one of the things you can do is use the Fibonacci extension. So you can click on this low here, go to the high here, and the lowest most portion of the range here, and you can see the 100% where A equals B is right here, right in the middle of this yellow box. So right around 1450, 1460. So once this pulls back into this area around 1250, you can trade gold for a $200 gain here up into the 1450 area. I got a lot of stuff drawn on the page there, but I hope that doesn't confuse everybody. But essentially, you've got an ABC move where B is a triangle, and then the breakout would be here, the upper line of the triangle. But if you understand Elliott and you believe this to be a triangle, then you also know that the breakout for the pattern starts here at the end of E. So when E is complete, you can buy here and pick up an extra couple of, what is that, $75 or so. So that's one of the benefits about Elliott Wave is you can, once you recognize that you're in a triangle, you can be a little bit more aggressive on your entries and more aggressive on your exits too. All right, let's look at silver. Silver's got a little bit different pattern, but gold and silver pretty much track each other. So you can just, pretty much count on that silver is going to be in some sort of C wave as well. I think the B in this case was kind of a descending triangle with a breakout to the low side, and I think silver's already in its C wave, so you could, in fact, right here is maybe a good place to buy, and then trade silver up into this $21, $22 area. All right, let's look at oil. Oil is always something interesting happening in oil. Oil looks like maybe it's trying to top in this pattern here. So also in a triangle, and you could see maybe this is kind of an ABC that would come down into this area. Let's look at this a little closer. See how this is probably A, and then B, and then C will come down into here, and then you'll bounce for the next leg of the triangle, and then once this triangle is complete, so here's kind of the first leg, A, B, C, A, B, C. So A, B, C. This is going to go on for a long time. Oil is going to trade in this range for quite a while, and then eventually it'll break out and make new lows. New lows for, what is that, 2016. So it'll go back to the old 2016 lows and slightly below, and then probably we're never going to see oil that low again. So that'll be historic. And the reason we'll never see oil that low again is probably because of our fiscal situation in the United States. We're probably not. We're probably going to abandon some sort of strong dollar policy and go with some sort of weak dollar policy, and continue to debase the currency. And of course, oil is sold in dollars, so if the dollars get less and less valuable, that means oil gets more and more expensive. So it's just unfortunate. That's just what governments do. So I don't know what else to say about that. But let's look at the GBP US dollar, because I think there's some potential opportunity there. GBP/USD. So, you can see here I've kind of been doing some stuff. Target's up here around 1.47. And, looks like we kind of quit pulling back right in here, and it's been chopping its way higher. I still think there's a good risk to reward here. You could put your low if you wanted to trade this currency. You could put your stop in below here and trade, from maybe let this finish pull. Maybe it's already done pulling back, and trade from here all the way up to these highs. And there's some pretty good duckies for that trade. And then once it breaks this, I think there's going to be a lot of momentum. It's going to move pretty quick up there. So keep an eye out for that. All right, the things I wanted to show you. So we were talking about, we talked about yield. Okay, the Fed's interest rate policy, and I wanted to show you here. So the red line is the U.S. funds target rate. This is the one they change every now and then. The Fed, what's called the Fed funds rate, and then the yellow line is the 3-month T-bill, and then the green line is the 6-month T-bill. And notice what happens. You just start anywhere along here, but let's just start here. See how the green and the yellow line are going up, and they're going up, and they're going up, and then right here, the Fed raises rates from here to here, right? The rates were here. Here, let's zoom in a little bit. The rates were here, and boom, right here on this date, right here, they raised them to here. But you can see that the treasuries were already going up, the 3-month and 6-month treasuries. Same thing here. They just kept going up, right? And once they were above a certain point, the Fed comes in and raises rates. Right here, raises rates. And there go the treasury, still going up. The Fed raises rates. So now, one of the reasons I want to bring this up is what I mentioned earlier. It's possible that if the market rolls over and things start to go south, the Fed will try to raise the lower rates. So they'll start lowering this red line, even though these rates are going up, let's say. And this, I think, is going to probably, if this happens, it'll have a severe blow on the Fed's credibility, which I'm really hoping for. I'm hoping they go ahead and try to lower this red line, this Fed funds rate, and these lines just keep going, and hopefully that'll discredit the Fed. Okay, so that's one thing I wanted to show you. This chart was in last Monday's report, and then Wednesday's report. Remember, we talked about market internals. So this is the S&P 500, and they've got this descending trend channel here, and we started running into some resistance right here. Obviously, just kind of like this one. This one touched it, sold off, retested, and then sold off. Okay, same thing could happen here. We could touch it, retest it, and then sell off. Okay, and the first stop will be somewhere below here, right around this 2700 area. But what I want to point out to you is this number here, 90%. So this is like the investors. Let's just think of it like bullishness. Okay, so at 90% bulls. Okay, so let's just talk about what this means. At 90% bulls right here, that means that there's 9, let's say like 9 out of 10 investors are bullish. Okay, but think about what that means. Okay, so if 90% are bullish, that means the 10% that are bearish have to have the same amount of money, right? Because the money part's always balanced in the market. So if I've got 50-50 bulls and bears, 50% bulls, 50% bears, that means the amount of money is equal on the bullish side and the bearish side. When I've got 90% bulls, that means that there's 9 times as many bulls as there are bears, but the bears have 10 times as much money at risk. And so this is what causes the market to start rolling over. So anytime you get a number like this, it can't hold that for very long. Now I can hold a 50-50 number or a 60-40 number or a 70-30 number. They can hold that for quite a while because the bears, they'll keep pressing those bets, and one by one the bulls will start dropping off in terms of how much money they have at risk. But this type of number here, you can't sustain it for very long because, again, the dollars are equal, but the number of people, the number of, think of it as like the number of trades, there's 9 times as many bullish trades as there are bearish trades, but there's 10 times, there's 9 times more money on the bearish side than there is on the bullish side. I hope I explained that well, but I want you to understand that these numbers are very significant. When you start getting to a downtrending line, an area of resistance, and you start seeing a number like 90, man, you gotta get to the sidelines. You do not want to be. You don't have to be a bear. You don't have to say, well, I'm going to go bearish. You don't have to be that decisive. But you need to get out of the bullish position because it means that this is going to flip and start heading down. Okay, so that was Wednesday's report. Now what I want to do is I want to show you Friday's report, and this is the kind of stuff I follow. Here, this is interesting too. The bond market volatility collapses to a record low. So that means there's nothing but bulls in the bond market, meaning yields are going to continue to fall, but they're not going to fall for a whole lot longer because you can't. For the same kinds of reasons, you cannot sustain these record lows or record highs for very long. If you look at this record high, I mean, look how long we were up there, not for very long. So same thing with the record lows. Once you reach one of these record lows, you're not going to be there for very long. So that's why I was saying yields could pull back to that 1.9 area. They could, but it's got to happen pretty fast. It's not going to take 3 or 4 or 5 weeks. Because this can't stay here for 3 or 4 or 5 weeks. Okay. This is another interesting chart. In 4 days, the KBW banking index went down almost 11%. So that's not a good sign. Usually when you see something like that dramatic happening, that means, and there's gaps in here too. So that means there is a lot of fear in banking right now. And you know, that's the way market crashes or market, you know, sell-offs, that's the way they begin. It's a financial thing, so it kind of begins at the banks. And then, of course, we had a pretty decent sell-off in the last couple of days. And you can see here, we were at 95. Remember I said you can't stay at 95 for very long. That means 9.5 times more money was on the short side than on the long side. But you had 9.5 times more bulls than you had bears. So you can't stay with that kind of imbalance for too long. And the market starts to sell off. So what we'll probably see, this is the NASDAQ. What we'll probably see is the NASDAQ come down somewhere below this low and bounce a little bit, and then we'll see that'll be it. The NASDAQ will probably fall pretty abruptly from that point. Okay. All right. Same thing. Daily sentiment index. You can see it on the NASDAQ, and we're showing here that this 5-way move is over to complete two of C, and so we're probably going to start falling. So I just wanted to show you how it can build up to that kind of analysis. I mean, you're not just guessing, oh, it looks like we're about done here. You're looking at the sentiment numbers, you're looking at the market internals, the advanced decline line, you're looking at all those things to try to determine is the market running out of steam here, or is it going to continue to go higher? Now you can just always look at the technicals, and that's fine. I'm gonna take that off because it's annoying. You can always just look at the technicals, and that's fine, and wait for it to break certain lows. What you notice about the market is it once it, not so much here, because this was a high and it pulled back, but once it pulled back to a lower high, and then this low here was broken, you can see that trend persisted. So that's what we're always looking for. We're looking for a high or a low, and then a move to a lower high or a lower low, and then a failure, and then we want to trade this. We want to invest in this, okay? Now on a really long-term chart, I mean, let's look at I haven't looked at one, but let's just look at it. Well, I don't know, that's not going to be, let's just say all. So these are monthly bars. So you can see what I'm talking about here. So the market ran up, and notice it broke this low, but it didn't really follow through much, right? It didn't follow through. It didn't follow through much until it broke the low after the high quit going higher. So once the market pulled back and then it rallied, but it didn't go to a new high, and once it broke that low, you can see it fell quite a bit. Same thing will happen here. This is a lower low, and once it fails this point right here, it's going to fall pretty dramatically. And now that we're on monthly bars, each one of these is a month, it'll probably fall all the way down into this area. For some reason, I'm on the EWU. I should have been on the S&P 500. Get on the S&P 500. Sorry about that. All right, so we'll zoom in here. Same thing though. You can see here, it fell here. We got to a high, it fell, but now this is a little bit different because it actually went to a higher high. But this is the nature of bull markets. Bull markets dive very hard. There's just a lot of, the world is mostly bullish all the time. So, this topping pattern has been huge. I was talking about that earlier, how long it's taken. I mean, this is what date is this? This is January 2018. So all of 2018, it went higher, but with kind of a weakening, and then toward the end of 2018, it started to sell off, and then into the beginning of 2019, and so this topping pattern is just it's just brutal, right? I mean, if you're a bear, you're just getting diced up, and then about the time you give up is when it really starts to head south. But you can see the topping kind of rolling over here that's happening. And it's happening right at a key area. You're getting a doji. So if we get, we're likely to get something that looks like that next week, and then it's likely to accelerate. It's likely to accelerate after that. So, and really start heading to the downside. Okay. All right, everybody, I hope that it's been an informative session for you. Again, this is the middle class investor, so we're mostly dealing with, we're not talking about trading in here, although you can follow this and do some trading if you want, but mostly what we're trying to do is decide whether or not we want to be in our 401k and what that mix in the 401k should look like. And right now, what I'm saying is that you should be going to cash and you should be working your way out of bonds. Because at the end of the day, what you want to do is when the market gets down into this area, or let's say 1400, you want to have something you can buy with. You want to be able to buy that move, because the market's not going to go straight down. It's going to go down to some level of support, and then it's going to find a bottom, and then it's going to start, and it's going to rally. And the bear market rallies are some of the most violent. You can make a lot of money. I mean, look at this. This was 2 months. I mean, if you had recognized this as support, in 2 months you made, let's see what that is from high to low. See, how do I do that? I know how to do that. I just forgot. Let's see. I go like this to I mean, let's say you didn't capture the whole thing from high to low. That's almost 22%. But let's say you just got half of that. That's 10%. You got 10% in 2 months. I mean, that's awesome. But you know, you had to have some money to buy with. You know, if you were just all in, then what are you going to buy with down here? I mean, I guess you can transfer some money out of your savings or boost your 401k. You know, a lot of people can't do that though. You gotta have some dry powder so that when you're down here, you can buy. So, I mean, just real quick, let's just mark this. Well, we don't have to mark that low. I just want to change it to a daily so you can get a sense of, you know, what that looked like. And then, well, let's go to a weekly first, and let's look at how we got our support. So here's our swing low right here. So our support is right here. We marked it in advance, okay? So if I'm back on a daily, say a 2-year daily, it didn't work, okay? And the market's pulling back hard here. Look at, I mean, you could have gotten in somewhere here, especially after this first day. Like after a day like this, you just could have gotten in somewhere on the pullback. Just, you know, when the market ran down a little bit, you could have said, okay, this is giving me my second chance, and then just let it go. And you could have made 10% easily out of this move very quickly. I mean, this move is a lot easier to make 10% out of than something like this where it's all chopped up. So these bear market rallies are always real strong like this. So, you know, but you got to have some dry powder. Okay, that's the thing. All right, everybody. Listen, that's it for this week. Thanks for coming in. Thanks for following me on Twitter, and, you know, tell your friends and family about us. You know, I don't do any advertising on this show or anything. I mean, I'm simply doing this because, you know, I think there needs to be somebody out there, you know, that's protecting these people in 401ks when everybody else is telling them, hey, man, just stay in. You know, you're going to miss the 5 best market days if you try to time this stuff. And look, for the most part, I believe that's true, but I think the circumstances surrounding our current financial condition are so serious and can be so devastating that I just don't think you can't afford to think that way right now. Okay, you just can't. And that's an opinion, okay? But you know, there's a lot of evidence to suggest that that's true. All right, so keep coming in. Share this with your friends and family, and we'll see you next week. Thanks, everybody. Take care. Bye-bye.